In this video, I'd like to discuss kind of the costs and benefits of choosing a 15-year mortgage versus a 30-year mortgage. So let's just say that you decided to buy a home and you'd like to borrow $90,000 from a lender, right? So you want to borrow $90,000, and let's just say that you're initially thinking, hey, I could do a 30-year mortgage at, let's say, 6.75%. At 6.75% interest, right? Let's say that that's your option. And so you say, okay, well, what mortgage payment is that going to come out to on a monthly basis, right? And let's say, and I'm just going to round here, rounds out to about $584 a month, right? And I'll put there. That's your mortgage payment, right? If you had a 30-year mortgage, 6.75%. But then you have a friend who comes over and says, hey, wait a minute. Why don't you get a 15-year mortgage, right? I got a 15-year mortgage. Why don't you consider that instead of the standard 30-year mortgage? And you say, okay, now let's just assume here that it's the exact same interest rate. In practice, that's usually not the case, but let's just assume here for a minute so we compare apples to apples. And this friend says, you know what, you can get that 15-year mortgage. And you say, sure, let me check out what my monthly payment would be. And so the monthly payment, and I'm just going to round here. Let me change colors. I'm going to round, and it's going to be $796. I'll just leave off the change for the rounding. $796 a month. Let me make that a little better. Okay. And you say, hey, wait a minute. Why would I choose this 15-year thing? Now I'm paying $796 a month, whereas before I was paying $584. So basically, you increased my monthly payment. Let's see what the difference is here. So we've got a difference of $212. It looks like, right? $212 higher when we do this 15-year. That's a lot of money, right? Every month, when you go to make the payment under the 15-year mortgage, you're going to be paying an extra $212, right? So you might have difficulties affording that, or you might think, hey, I had other uses planned for that money. And so you might be wondering, well, why? Why would anyone deliberately say I want this 15-year plan when I'm actually going to have a higher monthly payment, like a significantly higher monthly payment? And so there are several reasons why somebody might choose to go with that 15-year mortgage. And the first, and probably the most important reason I'm going to discuss here is you're going to pay less interest, right? You pay less interest over the life of your loan. Now, that might be counterintuitive to you. You might be thinking, hey, I have a higher payment here. What are you talking about, how it's cheaper? Well, let's think about your mortgage here for a moment. So we think, let's say here's year 0, and we go all the way out, and then let's say here is this is after 15 years. This is the end of 15 years, and then this is the end of 30 years, right? So this is years. So under the let me go, maybe we'll do the 30-year first. So under the 30-year loan, let me change, how about blue? Under the 30-year loan, what you're doing is you're saying, okay, we're going to make payments, 12 payments a year, right? Because there's 12 months in the year. You're saying we're going to make 360 payments times this $584 a month, right? 364 times 584. Now let's subtract out the principal, right? This is how much you're going to pay, right, over the life of the loan. And then I'm going to subtract out the principal. That's that $90,000. We'll take that out, right? And basically what we're trying to do is figure out how much interest you're going to pay, right? So we just basically take the total that you're going to pay, and then we subtract out the amount that was actually due to the principal, right? That's the $90,000 for the loan. And so it turns out that we're going to end up having $120,240 that's paid in interest, right? If you do the 30-year option. Now, what if we say, well, we want to actually just do this 15-year option? So let's take a look at that. So this 15-year option now you're going to have 180 payments, right? Because how do we get this 180? Well, this is just 12 months in a year, right, times 15 years. That's where that 180 comes from, all right? We're just saying every month for 15 years you're going to make a payment. 180 payments of 796, right? So that's that higher payment. So times 796, right? That's how much we're going to pay over the 15 years of the loan. But again, we need to subtract out the principal because we just want to drill down and say what is the interest that we're ultimately going to pay, the total interest if we do this 15-year option. And so we're going to end up with $53,280. Again, this is just, it's like this 180 times 796, that's going to be 143,280. Just put that there. It's not really that. And then we'll subtract out the principal, and that tells us what the interest is. Our total payments minus the principal is going to equal the interest, right? And now we see that we have a big difference in the amount of interest, right? Because if we do a 15-year loan, over the whole 15 years, we end up paying $53,280 in interest. But if we do the 30-year loan, if we go the whole time, then we pay $120,240 in interest, right? So that's a big difference in interest. Actually, let's calculate this out. So if we take $120,240 and then we subtract $53,280, right? We subtract, I'm just taking the interest on the 30-year and then subtract the interest for the 15-year to get the difference. We're going to have a difference of $66,960. So this is the extra interest you pay. Extra interest you pay over the course of a 30-year loan, as opposed to if you just said, I just want the loan to be 15 years. Now, why does this happen? Why do we have so much more interest? Well, that principal of $90,000, right? So the principal, I mean, it's not $90,000 the whole time, right? Because you're making payments, and each payment reduces a little bit of your principal. But in any event, your principal doesn't go to zero until the end of year 30, right? And under the 30-year loan. So this whole time, it's accruing interest, right? But with the 15-year loan, you're actually paying down because you have this higher monthly payment, but more of the monthly payment is going toward the principal, going toward that $90,000 that you borrowed, right? And when that $90,000 gets to zero, then you don't have any more loan to pay, right? So there's no principal here accumulating any kind of interest for the 15-year loan. So even though a 15-year loan would result in a higher monthly payment, right, by $212, you're paying the loan off faster. Each month, there's more of that payment that you're making that's going toward the principal, and so you're avoiding $66,960 in interest, right? And then also, as kind of a side benefit, another thing to think about is, well, we just mentioned, so every payment, every time you make this $796 instead of $584, more money is going toward the principal, right, under this scenario where you're paying on the 15-year of them versus the 30. Since you're paying the loan down faster, you're paying more toward the principal, you're building equity faster in the home, right? So not only do you pay less interest when we're talking about a 15-year loan, but I'll just put a second benefit here. You get equity, gain equity in the home faster. Gain equity faster, right? So you're building up, where you pay the principal, you gain equity, right? Instead of just paying interest, right, where you're not gaining any equity. So you're gaining more equity in the home. And if you decide later you need to take out a second mortgage, a home equity loan or something like that, you have more equity to draw from. And then kind of a third thing. So we had kind of assumed here that we just said, well, we're just going to have the same interest rate in each case, right? I just wanted to show you just apples to apples so you could see the differences in payments and so forth. But in reality, usually you're going to have a slightly lower interest rate on the 15-year loans, right? It'll be something like, let's say, 0.5% cheaper. So we'll say here is 0.5% cheaper. Now, this is just a rule of thumb, right? It's not always going to be 0.5%, but typically it's just, maybe we'll just put cheaper rate, right? So you can usually get a cheaper interest rate for the 15-year loan than you can for a 30-year loan. So that's another benefit. So, and again, now when I've talked about the payment being higher here for a 15-year mortgage versus a 30-year mortgage, if you're thinking about refinancing or something like that, then that might be a completely different situation, right? But in any event, we're not getting into refinancing. We're just talking about if you were to just straight up buy a house and you're just looking at the payments under each scenario, 30-year versus 15-year. Now, all this is making a 15-year look really rosy, right? It's saying like, hey, look, it's just like anybody, why wouldn't everybody do a 15-year? Why do we still even have 30-year mortgages, right? So we can kind of think about some drawbacks, right? Or you can call them disadvantages or however you want to think about it to the 15-year. So drawbacks to 15-year mortgage. And one of the drawbacks, obviously, is, and this is something we already showed, we have the higher payment, right? So the higher payment. Now, you might say, well, hey, you just sat here and told me about all these benefits of a higher payment. That's true. All those benefits are true. But what if you're saying, hey, look, I want that disposable income. I want to be able to do something with that money. I want to, I really like video games and I want to buy the new PlayStation or something. So if you're paying an extra $212 a month, although you're getting all those benefits we talked about, getting the equity faster, paying less interest, you're going to have less cash on hand, right? And you might say, you know what, it's really going to stretch my budget, and I really don't want to do that. Or it might be a thing where you say, you know what, I think I can invest that money better elsewhere, right? I'd rather take the 30-year, right, and get that difference, right? Remember, so we say, okay, there's this difference here, $212. You know what? I'm going to take that. I'm going to take this 30-year, and that $212 I'm saving every month, I'm going to invest that, right? So invest money or the difference elsewhere, right? So you're basically saying, maybe you can get. Maybe you say, you know what? I have this stock that I think is going to have ridiculous returns. And I just really want to invest in that, and I don't want to be playing around here with some 15-year mortgage. So let me just take the lower mortgage payment, and then I'll take that difference and invest it in the stock market. So as a rule of thumb, one way you might think about it is if you're going to earn more from your investment. So and we can think about this as the after-tax return. So if the after-tax return of your investment, whatever you're thinking of using that $212 for, if that is greater than what you pay for your mortgage after tax, so mortgage after tax, and I'm talking about that difference, right? That $212, right? That difference. If you say, you know what, it actually my after-tax return on an investment would be better for me than just saving that interest and stuff with paying down the mortgage faster. If that's the case, then think about the 30-year, right? But only you know that. It depends on the person. And so, but just another point, it's not just about kind of the disposable income and stuff. That's really not the only thing. There's really another important thing that we should think about, and that's how big a home you actually want, right? So some people will say, you know what, it's my first home, and I want to get as much home as I can possibly get. I want as much square footage. I want to max out, and you're going to be able to do that better with a 30-year, right? So a 30-year, because you're going to have smaller payments, 30-year you can afford a larger home, right? And the reason is that the lender is going to be looking at your income, the ratio. They're going to be looking at what your income is for a given month, right? They're going to be comparing your income, how much you bring home from your job, and they're going to compare that to your mortgage payments.